Hey everybody, I'm walking you through problem 31 as promised. I started to do this earlier today and I got frustrated because I got to one of the last requirements in the problem, and frankly I got stuck, and I think this is one of the few instances where there wasn't a lot of help from the text, and that's because the example given in the text, which is a really good one, and it walks you through the example step by step in the text, and I still recommend using this step-by-step approach to 751, to distributions where you have 751 assets involved. However, and as I'll explain to you, the situation was a little bit different. So what it tells you about 751 is that you are going to have, when you have a current distribution, a non-liquidating distribution, you're only going to have 751 treatment if the partnership has 751 assets and also non-751 assets, and there is deemed to be an exchange of 751 property for non-section 751 property. And so you can't even have this situation occur unless the partnership has both kinds of assets. And also a distribution that's proportionate to all of the partners, where there's not just a distribution to one partner where the one partner is getting diluted as a result of the distribution, so their partnership interest is going down from, say, 25% to 20%, then you can't have this situation occur. So this situation only occurs in instances where the partnership has both kinds of assets, 751 and non-751 assets, and the distribution is disproportionate. Okay? So, and you'll find when we get to the corporate chapters that there are similar rules where you have disproportionate distributions to partners rather than proportionate distributions. You have differences in tax treatment when that happens. So the example, as I said before, the example in the book ends up with a slightly different result than this example in this problem. So it was a little tricky. I think I've said to a few of you, there's nothing tricky about this stuff. The book's very good and clear, and then the homework problems identify back to certain sections in the text for each chapter. In this case, when you get to the last part, the analysis part, because this is a little bit different, you're not really getting help from the text, unfortunately. However, and what I've hinted at with you guys before, it's very helpful to use the help me solve this under the help section when you're in the problem. So you're up here in the problems, and there's this question help, and you click on that. Oh, that's in you're up here in question help. There's help me solve this. There's e-text pages, calculator, ask my instructor, print. Notice ask my instructor comes after help me solve this. So I really encourage you guys to help me solve this before you ask me, because as I'm going to show you, it's much more definitive, I think, and helpful when you use help me solve this. Okay, so that's what I did so that I could understand why I was not getting the right answer on this very last part. Okay, so the very first thing that we need to know is what a 751 asset is. And a 751 asset, and it's a beautiful thing, and this helped me solve this. What it does is it lays out for you the rules first, and then as you're going to see in this 6-page document, which I did this whole problem and helped me solve this, and you still have to get the right answers, otherwise it pings you until you get the right answer, right? Or it'll just fill it in for you. But when you get done with the whole thing, it'll say problem completed, and then you can go into the upper right-hand corner and print. And that's what I did. I printed it to PDF. And it would behoove all of you guys to do this with your problems. Print them out. I know there's at least one person in class who does this, and she keeps them in her binder. And she's going to be able to use her printed out, completed problems that have the right answer, plus all of the technical rules behind how to solve that problem, right? She's going to have it all printed out. So when she does the midterms and the final, she's not going to have to go searching through the book again, probably. She might have to sometimes, but she's not going to have to do it for a lot of these short answer problems because she's going to have everything printed out and she can just refer to that. And it's got technical reasoning behind the analysis. So first you need to identify what a 751 asset is. And a 751 asset includes unrealized receivables, which are defined as accounts receivable and also things like recapture items, section 1245 and 1250 recapture items. They don't give you that in the problem, but if you had some sort of an asset which had within it a recapture item, so a built-in recapture item that had not been recognized yet, then that would be an unrealized receivable. And you might see that in practice, but they're not giving an example of that in the book. And then inventory is the second kind of 751 asset. And in order for inventory for 751 purposes to be considered a 751 asset, it has to be substantially appreciated. And the trick about it is that you don't just, and substantially appreciated is defined as having a fair market value in excess of 120% of the basis. However, the trick is that you not only include the basis of the inventory, but you include the basis of the unrealized receivables in your calculation of this 120% test. So you would add the bases of both your inventory and your unrealized receivables, multiply those times the sum of those by 120%. And if the fair market value of the sum of those is greater than that product, that 120% product, then you have substantially appreciated inventory, and therefore your inventory is a 751 asset. Okay, so here's an example, and this is now getting into the problem. So this problem actually, and the one thing we don't get to see here, I might have erased it. That would really be bad if I erased it. Maybe I'm still okay. Because otherwise I'm just going to want to, let's see. Help me solve this. I'll bet you anything. I've got different numbers now. Yeah, I sure do. Okay. I'm going to have to go back to I'll go back to my problem here. Okay, so, bear with me, you guys. When this printed out, I don't have my, at the top of the problem where you press your data, you click for your data table, which shows you the assets bases and also the fair market value. I think I can give you those. You'll figure out what they are below here, but I'm going to have to walk you through that. So first of all, the basis of the unrealized receivables was 0, which it normally is for a cash basis partnership, and this was a cash basis partnership. So the unrealized receivables had a basis of 0, and the basis of the sorry about that. The basis of the inventory was 84,000. So the sum of the bases of the receivables and inventory was 84,000. I multiplied that times 120%, and that came out to 100,800. And the combined fair market value of the receivables and inventory was 38,000 fair market value of the receivables and 140,000 fair market value of the inventory. So that totals 178. So that actually exceeds the 100,800, which means that this inventory is actually substantially appreciated. Okay, because it's actually the fair market value of the combined inventory and unrealized receivables are actually in excess of 120% of the sum of their bases. So we do have the inventory and the unrealized receivables being defined as 751 assets in this problem. Okay, that's good to know. Then next, what we need to know is whether this current distribution, this non-liquidating distribution, is going to receive treatment under 751. And that's only going to happen if the partnership has, as I said, both 751 and non-751 assets, and a deemed exchange of those has occurred. And then what you do is any portion of the distribution that represents an exchange of 751 property for non-751 property has to be isolated, and you treat that not as a distribution, but instead as a sale. So we're going to be going through the process of determining, coming to a point where we can determine whether we have a distribution, which you'll treat as a normal distribution as you've learned in the rest of the chapter up to this point, or do we have a 751 distribution, which is treated as a deemed sale. And by the way, the sale can be a deemed sale of assets by the partnership to the partner or vice versa. And that's going to depend upon whether you have pluses or minuses in your difference column in column 5, as we'll see in the table when we get done with our analysis. Okay? So what you do to go through this calculation is you create a table, and you do it in a step-by-step approach. First, what you do is you, in the very first column, which is considered like column 0, you divide your assets into those that are 751 assets and non-751 assets. And so we're going to do that first. And remember, and you do this at fair market value. Everything that you do in this table for all of the columns actually, is going to be at fair market value. And then when we get done, the bases of these assets are going to come into play, but not until then. So remember from up above, the fair market value of the receivables was 38,000 and the inventory fair market value was 140. So they total 178. So we have total 751 assets of 178. We have total non-751 assets which just are comprised of cash. And all of the similar problems, by the way, all of them are the same. They just change the names and the amounts, but they're all coming out this way. So, and the fair market value and the basis, of course, of the cash is 30,000. So So that's my first thing that I have to do. Next, that's column 0, remember. And the book, by the way, lays all of this out. If you look on, and I just got clued in. Somebody was telling me at the office hours the other day that your page numbers or your paging is different. All of the material is the same, but when I've been saying like page 7 or page 5, you guys are like, no, Bonnie, that's like page 247 or something. So all I can tell you is you need to look under the big header in chapter 10 that says non-liquidating distributions with 751. And then under there, it starts to give you definitions of what is a 751 asset. And then the next page goes on to talk about how you build this table. And the page after that actually has an example with the table, with the data for the example given below it, and it walks you through it step by step. This is the same as the problem, except for one little twist, okay? So next, column 1 is going to represent the fair market value of the partner's interest in each of these assets before the distribution. And Grace, we are told in the facts up above that the partnership has no liabilities and each partner's basis in his or her partnership interest is $60,000. And on December 30th of the current year, which, right at year end, Grace receives a current distribution of inventory having a $13,000 fair market value, which reduces her partnership interest from 1/4 to 1/5, okay? And then the requirement is, what are the tax consequences of this distribution to the partnership, to Grace, and to the other partners? Okay, that's the to-do here. But there's a lot going on to get to that to-do. So then what we do is we say Grace owned an interest in each one of these properties. If you really think about it, she owns 25% of this partnership. So therefore, she owns 25% of the fair market value of each of these assets of the partnership. Because if you think about it, the partnership is comprised of a bunch of assets, right? Both tangible and intangible ones. In this case, it's all tangible assets, right? So Grace's interest is $9,500. You just multiply 25% of the fair market value of each one of these by to come up with her interest. So 25% of 38,000 is 9,500. 25% of 140 is 35. That totals 44.5. Total her interest in total in the 751 assets of the partnership at fair market value is 44.5. Her interest in the non-751 assets, which are comprised solely of cash, is 7,500. Now we get to column 2. Column 2 represents the fair market value of each of the assets. I don't know how to get rid of that. Do you guys actually see this? It represents the fair market value of each of the assets after the distribution. That's column 2. And with the exception of the inventory, all you have to do is just take your first column, this column 0, and now multiply it times her interest in the partnership after the distribution, which is now 20%, because it's gone down from 25% to 20%. However, with regard to the inventory, she actually received distribution of some of the inventory, a total of $13,000 fair market value worth of the inventory. So we need to make sure that when we're doing column 2, that we reduce the $140,000 by her $13,000 distribution before we multiply that times her 20% after distribution interest. So that's what I did here. I multiplied 20% times 38,000 and I got 7,600. With regard to the inventory, I took the 140, I subtracted $13,000 of her distribution from it, so that left me with 127, and 20% of that is 25,400. So after distribution, she has a total interest in the 751 assets of 33,000 and a total interest in the cash of 6,000. Then column 3, we've done 2 columns. We have column 0, 1, and 2. Column 3 shows a hypothetical proportionate distribution, because remember, this is not a proportionate distribution to all partners. This is a disproportionate distribution to all partners. In fact, no other partners are receiving anything at all. So it's a disproportionate distribution in that she's the only one receiving anything. So column 3 requires us to actually pretend like the distribution that she receives is proportionate to every other partner. So even though we're not showing the other partners as having received anything, we're pretending like what she receives is a proportionate distribution of every asset in that partnership, okay? And if that had happened, then this proportionate distribution would have been non-taxable to her, assuming that she has enough basis. Just like any distribution would be considered non-taxable to the extent of your basis, right? You only get taxed on the distribution if it's in excess of your basis, or, as we learned the other day, if you have a distribution, if some other person gets a distribution of property that you had put in, that you had contributed to the partnership and had a pre-contribution gain, then you have to recognize that pre-contribution gain later when that asset is distributed to some other partner within 7 years. So that could be an instance where you will be taxed on a distribution, and in that case it's not even a distribution to yourself, it's a distribution to some other partner, but you're going to be taxed on it. And that's really a recognition of a gain that's been deferred for some period of time. A little bit different than this situation. Okay, so then we calculate this hypothetical proportionate distribution very easily just by subtracting 2 from 1. So we subtract column 2 from column 1. So that's what I did here, very simply. And then we are on column 4. Now column 4 shows the amounts that were actually distributed. Remember, she only actually was distributed inventory with a worth of $13,000. So that's all I have here is 13,000. When you do this problem, by the way, make sure you don't stick zeros in here. I think you're just supposed to leave it completely blank. They don't want you to put zeros in there. And they tell you that, by the way. Now my dog's going to sit here and whine at me. No, go. Okay, so you add the 13,000 in there, and everything else is just blank. And now we're on column 5, okay? Now column 5 is just the difference between columns 4 and 3. And it's the difference between the hypothetical and actual distributions. This is the column where we are going to determine whether a 751 exchange has occurred. Up to this point, we're not even sure. So to compute the column 5 amount, you just subtract the column 3 hypothetical proportionate distribution from the actual distribution. If you get a negative amount in column 5, it means that Grace actually gave up her interest in a particular property. So in other words, if we have a negative amount, she gave up an interest. So here's a negative amount here in column 5. So her interest in the hypothetical distribution would have left her with $1,900 worth of receivables, hypothetically, if it was proportionate. But actually, she ends up with an actual distribution of nothing. So that means then that she, because that's negative, she gave up her interest in that $1,900 hypothetically. And a positive amount means that she received more than her proportionate amount, actually. So here, with the inventory, she actually got more than she should have hypothetically. So if she had received a proportionate distribution of all of the property, as is depicted in column 3, she would have only gotten $9,600 worth of inventory, but actually she got 13. So she ended up getting more than her proportionate interest. Okay? So that's what I did here. I just subtracted 3 from 4, and you either get a negative or a positive. It's just mathematical. Now, step 3. That was all step 2, was creating that whole darn table. Now, step 3, we're going to analyze column 5 to determine whether an actual 751 exchange occurred. And if column 5 in the total for the 751 asset section above is 0, so if this total right here is 0, then we don't have a 751 exchange, because all that would mean, if we had a 0, it would mean in order to get a 0, this would have to be negative 1,900 and this would have to be positive 1,900, for instance, or negative 3,400 and positive 3,400 in order to have a 0 in the total. And that would just mean that she gave up the same worth of one kind of 751 asset for the some other kind of 751 asset. And if that's the case, they don't really care and they're not going to treat it as a sale, and you can just go forward and treat it as an actual distribution, a regular distribution, and you would ignore this table from then on. You would just go back to your regular rules of distribution and look at whether she had enough basis to absorb the bases of the property being distributed, and if she did, you would just reduce her basis in the partnership interest by the basis of the property being distributed, and she would take basis in any non-cash property distributed equal to the basis that the partnership had in that property distributed, and so forth and so on, right? You would just follow the same rules. But in this case, it's not 0. So if it's not 0, then you know that a 751 exchange occurred. And the next thing that we're going to do is we're going to determine the gain or loss on the 751 deemed sale. So whenever you're determining what the gain or loss is on any kind of sale, you need to know what the difference between the fair market value of the property received was versus the adjusted basis of the property given up. So when you sell property, you're selling something that you had basis in consideration for something that you get back. Now, if whatever you get back, you're looking at the fair market value of what you're getting back, and you're comparing that to the basis of what you give up, and the difference between those two is your gain or loss. So for example, my couch that I bought 5 years ago that cost me $1,000, and and I haven't been depreciating it because I was holding it personally, right? It was just being used in my living room. But 5 years later, I give it to the partnership. I contribute it to the partnership. And at that, well, bad example, right? Because that's non-taxable to me. But let's say in exchange for that couch, which had a basis of $1,000, I receive back $500 worth of partnership interest. So that $500 worth of partnership interest is considered to be, that's the fair market value of what my interest is in the partnership, and I receive basis for that. And if I was actually selling that couch, let's say that I sell the couch on Craigslist 5 years later, I would get $500 in cash. That's the fair market value of the property I receive when I sell the couch. And what I'm giving up is the basis in the couch, which is $1,000. So I have a realized loss on sale of that couch of $500. $500 cash received minus $1,000 basis given up. So $500 realized loss, and it will be a recognized loss if it's actually a business loss. I don't get to recognize it. And remember, recognition takes place on your tax return. That's the whole idea of what recognition means. When you're not recognizing it, you're not putting it on your tax return. So you could have a realized loss, but you don't get to recognize it unless there's some provision in the code for recognizing it. And if I'm just holding that couch personally and I'm not using it in my business, or I can't take a write-off for it, then I don't get to recognize that loss on my tax return, okay? So that's what they're getting at here. Okay, so you look at the table above, and you can see that the amount that she realizes in her distribution, in her hypothetical proportionate distribution, is $1,500. And actually, we see that in the difference. You can actually look at the difference column too and see that she's actually realizing $1,500. And she is not realizing, she's realizing the $1,500 because actually the partnership in this case is deemed to be selling the inventory to her and in exchange for $1,500 that she's giving up. So, and that's a little bit different in the book, where the opposite is happening. In the book, the partner is deemed to be selling the property in exchange for proceeds. So the important thing, as you'll see below, is how this is affecting the other partners in the partnership, because this is actually a deemed sale by the partnership to the partner. And it could happen the other way, except because of the way the pluses and minuses are working here, in our case, it's actually a deemed sale by the partnership. So we come down here and we have the amount realized of $1,500, and then we have to figure out the adjusted basis of that inventory that was given up by the partnership. So in its deemed sale to the partner. So the way that we figure out the basis of the inventory, that's just the piece that's sold, because remember, not all of it's sold, only some piece of it was sold. Only $13,000 worth of a total worth of 140 was sold. So it's a proportional amount that we need to calculate here. So what we do is we just say, okay, the basis to fair market value of the total inventory as reported by the partnership is 84 over 140. Remember, the basis in that inventory was 84, and the fair market value is 140. So that's 60%. So 60% of that $13,000 fair market value will give us our basis of that $13,000. So that's all I did here was I took 60% of 13,000 and I ended up with, this is where I really wish that I could have cut out what I just said for the last 10 seconds and then just go back and start over, but I'm not going to bother to do that. So this is where I struggled a little bit with this, but I just realized what I did again, and I'm going back to correct myself. So the way that you calculate the adjusted basis of the inventory that's given up in this deemed sale is by essentially going back to column 5, taking the total 751 asset fair market value deemed to be given up here, which is $1,500, and multiplying it times that basis to fair market value ratio of the total inventory. Because remember, not all the inventory was given up in this deemed sale, but we're trying to figure out the basis of the inventory that was given up. All of the figures up here in the table are in fair market value, and we need to determine basis. So we multiply the 1,500 by the 60%, and then we get $900. So 1,500 by minus 900 is 6. Now, here's my issue with this is what I had the problem with earlier, and I kind of got annoyed, and then I had appointments I had to go to, and so I said, I'm not even going to deal with it. I really felt like what I should be multiplying that 60% ratio by was just the 3,400, because that's the only thing that was really given up was the inventory, and this is our deemed inventory that's really subject to the sale. But I think, and actually I just had a light bulb go off while I was sitting here saying this to you guys. Oh my gosh, I think I just maybe figured this out. I think the reason, they don't explain it here, but I think the reason why you're using the 1,500 instead of the 34 is because of that definition of what inventory is in my 751 definition, which I gave you before. And that is that your inventory includes your receivables. That might be why you're using the 1,500 instead of just 34, but I got the wrong answer when I multiplied 3,400 times 60%, and I got the right answer when I multiplied 1,500 by 60%. So, I mean, we'll have to research this, and if somebody does the research and comes back to me with the reason why you're supposed to multiply the sum of all those 751 assets in column 5 times the 60%, I mean a technical reason, like it's explained in the book, and you come back and you tell me why, or you go in the code or the regs under 751 and you find the reason why, I'll give you 5 extra points if you guys come back, okay? Has to be the first person who comes back to me. I'm not going to give everybody 5 points. All right. So that's what I did. That comes up with my recognized gain, and it's going to be ordinary in character. Why? Because the character of the stuff that I'm deemed to be selling is ordinary in character. Inventory and unrealized receivables are both ordinary income assets, so it will be an ordinary income. Now we're supposed to show how the distribution affected each partner's basis in the partnership. So what you do is you begin by entering all of the partners' beginning bases, And that was just shown, that was given to you in the information above. It said that on January 1, each partner's basis was 60,000, or maybe it said on December 1, it doesn't matter. But it was before the distribution, each partner's basis was 60K. Then, and this is the tricky part, what you're supposed to do is allocate the $600 gain that's a deemed gain realized by the partnership, actually recognized by the partnership, recognized, not just realized by the partnership on this distribution. You allocate that evenly to each of the other three partners. Grace is, you'll see down below, she's going to get her distribution shown as, you know, it'll get affected to her basis too, applied to her basis. But the other three partners just share evenly in the gain. And I think that's because each one of these partners is deemed to own an equal share in the partnership, 25, 25, 25, 25. So they each get $200 of the 600. So each of them will have an ending basis equal to the sum of 60 and 200. And then we have to show for Grace her the effect on her basis of this distribution. So first, she's deemed to have a deemed distribution of cash. Okay, up here, this is a deemed distribution of cash of 1,500. So that's a minus to her basis, a reduction to her basis. And then she's deemed to have a distribution of inventory, and now you have to calculate what her inventory distribution is. And so you go up to the hypothetical distribution of 751 assets up above, and it shows you that her hypothetical distribution, see, here's where we're going from this column here when we're talking about what we're actually deeming her distribution to be. So her hypothetical distribution of cash is 1,500, and her hypothetical distribution of the inventory is 11,500. And notice they've included in there the hypothetical distribution of the receivables, and I think that's because the receivables are included in the definition of the inventory under 751. So we then know that it's 11,500, but that's at fair market value. So again, we have to multiply that times that 60% basis to fair market value ratio that we used up above. And the result of that 60% times 11,500 is 6,900. So I just subtracted 1,500 and 6,900 from her $60,000 beginning basis to come up with a basis of 51,600. And then I added the $200 recognized gain, deemed gain, on the deemed sale to the other three partners' bases, and I got 60,200 for them. Last, we need to determine Grace's basis in the distributed inventory. Okay, like she actually did get some inventory, and what is her basis in that inventory? And so what you do is you essentially give her a basis equal to the sum of her actual or her deemed distribution of cash plus the inventory. That's going to be the basis she takes in the actual distributed inventory that she gets. So, which kind of makes sense, right? Because what we've learned in a regular distribution situation is that what you take basis in your non-cash property, what the basis that you take in a distribution of non-cash property is the same as what you're reducing your basis in the partnership interest by. So because she's reducing her interest in the partnership in total by $8,400, which is the sum of the deemed distribution of cash and the actual distribution of inventory, that it makes sense that her basis in the distributed inventory is going to be $8,400. Now, here's some more information that it gives you at the bottom here. Like these are footnotes. So it's footnotes about what the definition of unrealized receivables. It also talks about the different types of the three major types of inventory that you can have that are deemed to be 751 assets. And then it also talks about distributions from a partnership fall into two major categories, liquidating and non-liquidating, and what that means. So they're just trying to give you some more examples here. This is why I love this Help Me Solve This. Just doing this problem and then printing it out like I did, I think is very helpful. Well, this has been a 46-minute lecture, which maybe could have been a little shorter if I hadn't done it at, started doing it at 10:15 or 10:30 at night. I'm going to bed now, and I'm going to do my bike ride tomorrow. And then tomorrow afternoon, I'm going to come and do office hours with you guys. So thanks for bearing with me. I hope this has been helpful. Talk to you later.